Sports teams have become big business with record multi-billion-dollar valuations in the NFL, NBA, and other major leagues. Private equity is now getting into the game, and leading the charge is Arctos Partners, the only PE firm with stakes in all the big leagues. Ian Charles is the co-founder and managing partner. I'm Robert Frank. This is Inside Alts. Ian, thanks so much for joining us. So you've been in finance a long time, especially in the private equity business, which has gone through a lot of change, particularly in the past couple of years with consolidation, the rise of these mega firms. We've got returns coming down. You once said, I think, that this is no longer the industry that we grew up in, that you grew up in, that you grew up analyzing, that people invested in. What did you mean by that statement?
Well, I think the private equity industry is going through a period of maturation. I think the end client needs alpha more than they've ever needed it before. And managers are starting to coalesce and understand how they generate alpha in their own unique way, how they connect with the customer. And that is a period of transition that is hard. It's a different model, it's a different reality, but I think that's our new world.
The question is, what are you transitioning to, I guess? Because a lot of people see returns coming down and there's just so much money chasing deals that people wonder, whether this will be the original promise of private equity, which is delivering alpha and truly finding companies in growing industries that you can add value to.
I think the right question is how many managers and end clients and customers understand the extraction of alpha from beta when you talk about something like private equity. As the private equity market has matured, there are firms that are becoming very good at generating an attractive amount of alpha at tremendous scale, and there are clients that need that. There are also clients that need a lot of alpha in just enough quantum. And so you have specialists that are bringing very differentiated products to the table where that big alpha harvest is possible. So the client need is evolving, and firms are having to change to meet that client need. We can't all serve all clients anymore. And I think that's the disruptive, uncomfortable reality for a lot of managers.
Do you think the environment for private equity in 2026 will get better? There was this hope at the end of last year. Finally, we're seeing IPOs. Finally, we're going to see some distributions from the private equity side. Is this going to be the comeback year for private equity?
There was a lot of euphoria and really positive narrative this time last year. We were not part of that. The machinery that we have was not predicting a robust distribution yield.
What did you see that was different?
We saw a divergence in the valuations in the public market and the private market. We saw a set of incentives that were changing, and both of those were flashing yellow and red last year.
So we've had public markets just continue. 3 years of double-digit gains, and you just feel like the marks, the values in the private market don't match.
To have a very
still need to come down, maybe.
To have a very robust distribution environment, private equity needs to be cheap relative to public equity.
Okay.
The incentives have to be aligned between the GP and the LP to harvest, and you need sponsor-to-sponsor transactions, which is really where the cost of debt and the valuation of an asset kind of converge. You need those three things to both be flashing green to have a tremendous distribution yield. Today, they're flashing yellow and green. And so we actually think, and we didn't think this last year, we think 26 could be a relatively strong distribution yield, but for very specific kinds of funds. Not all funds.
What kinds?
We think younger funds that aren't weighed down by high valuation entry points, kind of 2021, 2022. We think very large funds that can tap the IPO markets or whose assets are very strategic. So bigger funds, younger funds, and funds that aren't as exposed to the disruptive obsolescence risk of AI. That's where we think a lot of the healthy monetization is going to come from this year.
And sports is what I'm so excited to talk to you about, because when I talk to wealthy investors and family offices, the two themes they are obsessed with right now is AI and sports. AI is depressing, it's complicated. Sports is exciting. But the big question around sports, and we'll start out with this, is it truly an asset class, or are we talking about sort of trophy assets that, yes, if you look at a select group number of NFL teams, NBA, they've soared in value. But as a broad asset class, why should it be attractive to private equity investors?
That's a killer question. So when we talk about sport, we're not talking about the broader sports ecosystem. We're very focused on the 150 to 200 premium global sports brands that are predominantly in North America.
Teams.
NBA teams, NFL teams, Major League Baseball, the National Hockey League, and then some very unique, very important global sports franchises in European football, Formula One racing, etc. So
you're not talking about like the media brands around it. You're not talking about the technology around it. You're not talking about like the retail around it, et cetera. You're really talking about investing in teams. Or are you talking about?
We think the intellectual property that powers everything you just described is owned by the leagues and the teams in the premium North American sports leagues. What you're also talking about is emergent leagues, and then picks and shovels businesses like sports gambling, sports tech, youth sports. Those could be really interesting deals, but we don't think there's any unique inherent characteristics or beta factor there. What we believe strongly is that those premium sports assets behave differently. They're anti-cyclical, they're anti-fragile, they're uncorrelated, they're underlevered, and despite all of those really nice durable attributes, they have performed on par with or better than public equity and private equity over really long horizons.
You're saying those valuations, I don't know how you're measuring which basket or which leagues, have outperformed public equities over what period of time?
It's very, very hard for you to find a 3, 5, or 10-year period where public equities has outperformed premium North American sports.
Wow.
There are small 2 to 4 year windows where that's true, but it will outperform sports by 400 basis points, not 20. What's really unique, though, is the consistency of that compounding in professional sports, the low volatility, and the fact that that return comes with lower negative correlation to both traditional and alternative asset classes. And so even with no alpha, we just talked about the importance of alpha and beta, that beta by itself is a return enhancer and a risk reducer in a portfolio. And our job is to add alpha to that.
I promise I won't ask you if sports is in a bubble, because you get that asked that all the time.
You can go wherever you want to go.
But I will ask in the sense that, okay, NFL teams will always be NFL teams. No doubt that those values will keep going up. The rates are, we'll see. But when you look at these emerging leagues, padel, various electric sailboat racing, et cetera, where they say, wow, look at the values of NBA. This is the NBA 40 years ago, 30 years ago. Where do you think there is over-exuberance in the sports space right now? Is there?
Well, I think what's really challenging is when you have sponsors and the GP community focus in on a new thing, it starts to get to be a crowded trade. So I worry about some of the picks and shovels and sports ecosystem businesses. I worry about some of the emergent leagues.
What's in the picks and shovels category?
That could be venue services. It could be ticketing. It could be sports data, youth sports. There's dozens and dozens of like sub-themes within the sports ecosystem. Emergent leagues are, like you said, e-racing and drone racing and pickleball and padel, and I have no idea which of the professional pickleball leagues is going to be the premium source of content in 20 years. I do know that when there is a Super Bowl in 2045, it's going to command the attention of the entire world. And so where we focus is those premium sports brands where that content actually moves the entire media landscape, and it matters in one of the most important markets in North America at the local narrative level. That's very unique.
I mean, we have seen UFC rise in popularity.
Yep.
What could be the next UFC, do you think?
What could be the next UFC? Listen, I think that one of the women's sports leagues is going to ascend and command global attention. I don't know which one it is. I don't know where it will be based. Is it a global league? Is it a continental league? One of them is going to capture the energy and the fandom of the globe, and that has the potential to be UFC equivalent. But which one of those leagues is hard for me to tell and have conviction around.
And so tell me about the process of investing in teams and leagues? And are you mostly focused on working with the teams to figure out where you can help them with capital solutions and liquidity? Or are you more focused on democratizing sports for a broader investing audience?
One thing that a lot of people don't understand is that in the North American premium sports leagues, every one of those clubs is actually at least two assets. Every club owns an equal pro rata share of their league. Think of that as like a global IP business that just throws off a cash dividend. And then there is a local live entertainment business. Sometimes it has a venue, sometimes it doesn't. And your opportunity to monetize this protected geographic region where no one is allowed to compete with you in your particular form of live entertainment, those two assets are quite unique. You have this very durable, very important IP piece, and then this local live entertainment piece. Every NFL team owns the same dividend from the league. Doesn't matter if you're first place or last place, big market, small market. Where the differentiation happens is at the local level. And so we have some very sophisticated machinery that measures and assesses operator skill in two areas. One is creating hope for the fan, and the other is monetizing that hope, commercializing that hope. And there's a feedback loop there. The better you are at commercializing, the more value there is to pour into hope. And operators that are good at both of those create phenomenal brands over a long period of time. And so we have some very sophisticated tools to measure operator quality. And then our job is to be the best partner we can to help that owner and operator unlock their vision.
Yeah, we're in the Giants and Jets city. Not a lot of hope for those fans right now.
Hope ebbs and flows.
We've heard about teams themselves being not great businesses in terms of generating profits. You just sort of hope that at some point someone will pay more for that team in the future based largely on media rights. And so do you think media rights will continue to grow, and I'm sure you look off to the side at what's happening with streaming, what's happening with consolidation in media. Do you think that will continue to drive values in the sports world?
So I'm going to come back to your question about media rights, but I want to go back to how you set the question up with the structural profitability of these businesses.
Yeah.
Because I think the misconception that these businesses are not profitable was true 20 years ago. But over the last 20 years, as revenue has continued to compound at 6 to 10%, player costs as a proportion of total revenue, the players have become partners with the leagues in growing these businesses. So gross margins have expanded. The proportion of your revenue that is long-term and contracted has gone up almost 5x. And the operating margin in the big four premium leagues has gone up 2.5x in the last 15 years. So the fundamentals of these businesses have improved dramatically.
Is that mainly, again, being driven by the share of media right money, as opposed to like we're getting more for the sodas and the hot dogs and tickets that we're selling in the stadiums?
At the league level, it is because this intellectual property is becoming more and more valuable because of how AI is impacting the entire media landscape. And so we can go back to the two themes that your audience is really interested in and how they intersect. But as this content becomes more valuable and more critical, the ability of the leagues to monetize that and then share those equally with each of the owners in the league is a really powerful part of why these assets are so unique. Because it doesn't matter how your team does, the dividend from the league is the same.
So you think AI will actually make sports rights more valuable in the future?
Absolutely.
Why is that exactly?
No question about it. So today, all of the production in Hollywood produces about 15,000 hours of content across all forms of scripted. Today, just on YouTube, there's 500 million hours of content that's uploaded each year. If agentic AI tools can make even 0.02% of that good enough for the end client, the end customer, just 0.02% of the content today is all you need to convert to have self-user-generated content equal all of Hollywood's output. So I think the cost of scripted content is coming down towards the cost of compute. And that content is so individually personalized, there's no communal experience, there's no shared experience. Sport is the only must-see appointment viewing content. And in a world where people are increasingly lonely and looking for a connection, the communal, tribal connection you get from watching a sporting event with your friends, being part of your community, crying and screaming and cheering, the value of that to the media landscape and ecosystem is just becoming exponential.
And you know it really happened. You know
Yes,
it's real.
and you
It's
know
not slop,
and
AI
you
slop,
experienced
right?
whatever emotional response at the same time as everybody else. And so in a world where the value of the content only comes from one of two things, does it drive subscriber value or advertising value? Sports is the only content that moves the needle on new subscriber numbers for the streaming platforms.
And when I talk to high net worth investors and family offices, there is this deep interest in sports, but there's a bit of confusion about the best way to do it,
Yep.
the best way to invest. You could either be the next Jerry Jones if you're a multi-billionaire
Yep.
and can afford majority of an NFL team, or there's a fear that you're just buying very expensive courtside seats somewhere. What advice would you give ultra high net worth investors and family offices about the best ways to invest in this?
Well, I think for this particular kind of asset, you have to understand your utility curve. If you're really just trying to...
What does that mean?
What makes you happy? What goal are you trying to achieve? What problem are you trying to solve? If you're just looking for a great risk-return, kind of sharp ratio to add to your portfolio, I think owning a diversified portfolio of premium sports assets is a very additive thing to bring to your portfolio. If you're looking for the opportunity to have your heart race on the outcome of a game, to feel really vested in a particular franchise or a particular city, if you aspire for a differentiated kind of civic leadership, control owner in a premium sports team in North America or around the world is a very unique platform. It's really hard to get. They don't happen very often, only 4 or 5 times a year on average. And if you are wealthy enough and that's something that you're prepared to spend a decent portion of your life dedicated to, it's a pretty phenomenal thing. But if that's what you want, you've got to be really serious because it doesn't happen very often.
So you mentioned that sports is true alpha in that it's not in correlation with the stock market, or in some cases actually outperforms the stock market. Why is that?
Well, premium sports is one of only a handful of industries that for decades has been able to compound revenue at sort of better than inflation, better than GDP, sort of a 7 to 9%. Healthcare, education, and sport. But all three of those have been anti-cyclical for slightly different reasons, right? They've got this sort of monopolistic, local live entertainment business in sport that's really interesting. But 70 to 80% of the total revenue in premium sports is long-term and contracted through sponsorships, through media rights, with guaranteed payments and escalators. So it doesn't matter, did GDP go down, did it go up, what were the ratings, what were the ad spend?
Because these are long-term contracts.
Just long-term contracts, and they pay. And so the variability comes in when those media rights get repriced.
Come up for...
And then the variability comes year to year through ticket and sponsorship and premium at the local level. But for many of these businesses, the demand for that local content, that local experience is significant. And so after rent, after food, it's one of the top spends for the families that consume this content. And so even the ticket pricing is very durable and anti-cyclical. And so when you combine those things and the improving fundamentals of the margins at the gross level and at the operating level, that profile is very hard to find in the S&P 500.
I'm surprised. I know that people love their teams,
Yeah.
but I'm surprised in a time of recession or right now when we have many people under pressure from inflation that you're not going to see a decline in ticket sales. They're not going to buy that extra expensive meal at the stadium. They're just going to eat before they get there. I'm surprised that part of it is not cyclical.
So maybe they order a slightly different concession in venue.
Okay.
Right? Maybe they buy a quarter season package instead of a full season package. But this is a really important part of their family ritual. And they're not going to not experience this as a family. And so they prioritize it. So even when they're cutting different parts of the budget, they prioritize this because they have a real emotional connection to this product, to this experience. that's very rare. It's very hard to find. And what's really beautiful is the acquisition cost of a new customer is almost zero, because it's part of your family's rituals, and you inherit, your team from your community or from your family. And as long as you provide hope over a long enough period of time, you can build real brand value there.
Do you see value for Arctos in the international expansion of some of these leagues? Is there a real opportunity there?
The international opportunity is huge, not only for the clubs, but for the leagues. Like, if you think about all of the international games the NFL is playing today, the NBA is in the press about trying to grow its footprint with the NBA Europe, Four Nations tournament in the NHL, pitting the best players in the world against each other, but domiciled by their own country. Even Major League Baseball with its international games. Growing the game internationally, monetizing the customer relationship internationally is a huge part of the league level growth initiative. And it's also a part of the media ecosystem that I'm very excited about. Like, imagine being able to reach young fans of the sport in their native language on streaming platforms. That's
What's an example of that?
Well, my favorite example of how augmented reality and tech is going to bring our sports to the global community is examples of putting kids, grafting them on the players real time on streaming platforms. So you might be able to sit down and watch a game with your daughter and have her be the point guard of your favorite team for a $5 upcharge. And she may not want to watch basketball, but sitting there with you, watching herself play while you're watching your team, real time, no lag, that's coming. And the fandom that you're going to be able to create for a whole new generation of kid, where it's hard to keep their attention, they're going to want to watch themselves in that game. And that tech exists today. Adam Silver demonstrated it at the NBA Tech Summit a couple years ago. It's really incredible.
And it's not through mounting cameras on people's heads, right?
This is pure augmented reality. This is just grafting a quick picture of your kid onto the player of your choice as a service. And one of my favorite stats that I've learned in the last 6 years about sports is if you can get a kid in a venue before they turn 13, they identify as a fan of that sport for life, 90% of the time.
Wow.
I don't know what it'll be if the kid's not in the venue, but they're sitting next to their father watching the game together. But if it's 50% and it's global, that's a massive opportunity for the North American sports leagues.
Ian, thanks so much for joining us. We appreciate it.
Awesome. Thank you.